a new ATFX report. This is the summary of the week. This video is just to give you an update about how this week, 15th of December, ends. So by the time you see this week, this video, you probably are starting the next week, Monday, but you're gonna get a nice picture summarizing all, and I'm gonna try to make you understand, in my eyes, in my view, what's the situation of the global market right now. It was a very, very interesting week. We got just a refreshing you and reminder. This week probably is the most important week for the last 3 months. This week actually changed completely the perception of the market. We're gonna take a look on the charts later in a few minutes. But in summary, this week we got Federal Reserve and we also got Central Bank of Europe comments. It was also the interest rate decisions from Bank of England, Swiss National Bank, and so on. But the most important one, it was obviously the Federal Reserve. Actually, I'm checking my notes because early at the beginning of this week on Monday, I was just taking a few notes about what was the most important macroeconomic data that could affect the market this week. And on Tuesday, we got the UK unemployment rate plus. We also get the ZEW indicator of economy and confidence from Germany, but also the same indicator applied to European activities. Numbers were actually not so good. In the case of UK, we actually see that the growth rate of UK is dropping. It was minus 0.3% with an expectation of 0% of growth rate. The unemployment rate was little bit rising for just a tiny bit. United States also published the inflation rates on Tuesday. But the most important day, as I was saying, it was Wednesday morning. We got the GDP of United Kingdom, as I say, industrial production from United Kingdom. We also got the trade balance from United Kingdom. But we got on Wednesday the most important meeting for the last 3 months, as I say, which was the meeting from Federal Reserve. And in this meeting, my friends, everything has changed. In this meeting, Jerome Powell, the chief of the Federal Reserve, put over the table the option of an interest rate cuts the coming months, 2024 next year. Which means it was actually a surprise, I have to say. I believe the market was discounted. Let's take a look on the chart now. The market was discounted, obviously, positive news, which probably means it's like a more dovish position from the Federal Reserve. And by dovish, I mean more softer monetary policies. As you can see, we can actually identify 3 bullish movements here. The first one initiated four weeks ago by the end of November. That bullish market was starting with certain results from the labor market, which was actually weaker. I'm talking about, for example, the unemployment rate was rising a little bit. And by that Friday, when we got those numbers, Cascaris from Federal Reserve mentioned how useful was those numbers for the market, for the global situation, and so on. It was that moment when the whole market, the whole system started to understand or metabolize the idea that the Federal Reserve will not increase interest rates anymore. And therefore, we were in a pike of interest rates. And therefore, the coming months, all we could expect, it was interest rates cuts. That was the theory. And that theory was moving the market up, and up for the last 4 weeks. But yesterday, my friends, Jerome Powell confirmed that theory, not even recognizing that interest rates are not going to rise anymore, but even suggesting the idea, the possibility, the option that actually interest rates could get cut, even if United States didn't reach the 2% of inflation rate, target inflation rate. So they were suggesting, we believe that actually the pressure we apply on the monetary policy, the pressure we apply on interest rates is affecting in long term the economy, and therefore we could even consider interest rates cuts in the coming months if the economy needs so. Also considering that the effects on the interest rates applied for the last few months, for the last year, is actually gonna keep ongoing in the coming quarters. So that was a kind of truth that it was revealed on the market. And the response of the market was absolutely crazy. It was a party in Wall Street. Take a look. We actually breaking out new maximums. We're almost there. If you take a look on the chart right now, you can see the Standard & Poor's, mini Standard & Poor's contracts, futures. and you can see that it's almost touching the maximum 4,800 points generated by mini Standard & Poor's January 2022. So since then, we never have seen this movement. For the last year and a half, let's say, we have been almost 2 years. We have been in a market that it was lateralizing all the movements of the prices, even dropping. Just like a couple of months ago, we were actually facing one of the worst market situations with the fears of a Middle East war between Israel and Iran, with also the fears and the problems of the complication of Ukrainian war. All of these factors were actually affecting the energy market, because it was affecting the oil, it was affecting the gas, it was affecting international relations, it was actually affecting even the trade relations, international trade relations, because it's affecting also the relation between China, between the United States, in terms of exportation of certain minerals and technology and so on. It's a trade war at the end of the day. In this case, we never expect that actually US economy could make this move. Why not? I'm gonna give you certain numbers and facts why we could never expect this movement, at least not myself. If you check also the growth rate of the United States, it was actually 5.2%. 5.2%. Yeah, 5.2% was the last growth rate published by United States. And being honest, let me share the screen with you. Being honest, if your economy is growing by 5.2% and your unemployment rate is below 4%, there is no excuses to apply any monetary stimulus. You're actually good. You are actually good. So Federal Reserve should not need to take any kind of measure of interest rate cuts considering this. Because the economy is going. Take a look. United States growth rate 5.2% interannual. 5.2%. Compare those numbers with Europe, minus 0.10%. Europe probably needs some certain stimulus, certain helps. Europe probably needs interest rates cuts. Europe probably needs even tax rate cuts. Europe needs a stimulus. Europe needs actually a push to take them reactivate their economy. We have seen the last few months how German industry is actually dropping in production. Also, Netherlands is dropping in production. Even Italy is dropping in production. The growth rate is negative for Germany, for Netherlands. Even United Kingdom got a negative growth rate. Therefore, all the area of all the area or zone of Europe are actually facing a recession, an economical recession, but not United States. So we could expect that kind of position of more soft monetary policies from Central Bank of Europe, from Bank of England, but never from Federal Reserve, unless the true Federal Reserve is not the Central Bank of the United States. Federal Reserve is the central bank of the world, and that's why they are cutting interest rates. That's why they're gonna cut interest rates in the coming months, because they are responsible for the world currency, which is the dollar. And therefore, if we know and we see the European Union is getting into a recession, and we know and we see by data that China is slowing down, and I'm talking about prices of overproduction in China just dropping in deflation for the second time on the year, there is a real risk of China growing slower than expected the coming months. And therefore, Federal Reserve is just simply saying, if that's the case, we're going to take measures. If that's the case, we're going to actually cut interest rates. Boom. It was completely a party for the market. Please, applause. Really well played. Really well done. Market is completely crazy. The only problem, my friends, if you take a look on the chart closely, you will see that it's super weird. See all this vertical movement without corrections. You see? 1, 2, and 3 movements up, going to the maximum with no corrections. If you take a look on NASDAQ, you will see exactly the same situation. Super vertical moves. In the case of NASDAQ, certain pauses, but still super vertical. And in the case of European markets, we got DAX 40 on the screen. Extremely vertical movement. Where the hell the market is going? What is going on? This is not natural movements. The market should rise, of course, with certain corrections, certain Fibonacci retracements, 38.2%, 50% of the movement, and then let's keep going, let's buy again. This is extremely buy signals. That only means, in my eyes, in my opinion, that the market is completely intervened, is completely triggered, is completely, how can I say, we are not facing a natural movement. We are actually facing a market that has been intervened by probably central bankers. So I think that's the only true. And we will say, if the movements are so vertical, also the corrections will be. Which means, please be careful with this market. Pay attention. It's not time to start to buy. If you would like to buy this market, the party started a long time ago, 4 weeks ago actually. Now it's too late. Now if you start to buy any particular stock, any particular equity, you like it on European market, on German market, or even the United States, you got the risk that those markets gonna actually go in a contraction sooner or later, because they cannot sustain or keep this movement forever. And therefore, because the movement was so aggressive in their way up, they probably could be aggressive in the way down. So just watch out, be careful, be cautious, and be smart. Do not expose yourself to these movements, okay? That was in concern of the Federal Reserve words. Now, what happens on Thursday? Because on Thursday we got actually the other side of the coin, which is Central Bank of Europe talking about what's the position the Central Bank of Europe gonna take in the coming months for the monetary policies in Europe. And surprisingly, they don't even mention the option of interest cuts. One journalist was asking actually Christine Lagarde, have you ever considered also the option of interest cuts? Have you discussed internally in the Council of Central Bank of Europe the option of cut interest rates? The answer was clear, no. We didn't discuss that topic. We didn't discuss that point. So it means like an economical zone, which is Europe, which actually is in a recession, which actually needs certain help, is not considering this option. The United States, which is actually growing by 5.2% annually, is considering interest cuts. United States with an unemployment rate below 4%, with the last labor report published last Friday, not this one when I'm doing this video, 15th of December, the previous one, it was even better than expected. The unemployment rate was actually again dropping from 3.2 to 3.7%. Amazing, amazing. Does really US economy need any help? Doesn't look like. If you check the numbers, doesn't look like. However, Federal Reserve is considering and put over the table the option of interest rate cuts in the future. That's amazing. That's amazing. And again, the only explanation for this is because Federal Reserve is acting as a central bank of the world, globally. Not because United States, but because the dollar, the US dollar, is the world currency, and therefore they need to act as a central bank of the world and facilitate certain liquidity for the next year in case that the global economy is actually slowing down, which is the case what we suspect. Europe is in recession and China is slowing down. Okay, sooner or later, United States is going to be in the same situation unless they start to give certain hopes to the market, right? And the hope was there, and the market has been responding. All up, 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 up. Even European market is rising, not because of the words of the Central Bank of Europe, but because of the words of Federal Reserve. Amazing, amazing. Central Bank of Europe say yesterday, Thursday, stop. We are not considering cut interest rates. We are actually, she was mentioned, actually, Christine Lagarde was mentioned, officially two official posters from Central Bank of Europe. First one, it was the compromise, the completely decision, a strong decision they took it to keep interest rates as high as they are right now. The time is needed until the inflation came back to the desired level, which is 2%. So they say, we're going to keep the interest rates. We are not considering cut it. We are going to keep the interest rate as long as it's needed. Don't even think for a second that we are considering cut interest rates like the Federal Reserve mentioned. We are not talking about that. That was the message, more or less, between lines when she say, we are so compromised to hold our interest rates until the inflation is not at risk anymore. Second point, they mentioned also the reduction of balance sheet of Central Bank of Europe by not renewing and selling the bonds PEPP, which is the bonds they put in circulation to fund the fiscal expenditure to cover the COVID crisis the last 2 years. So that fiscal expansion, that increase on public expenditure was funded by these bonds, and they actually mentioned they're gonna reduce the balance sheet by taking these bonds out of the balance, which means less liquidity. If I'm selling bonds, means I'm recovering the euros and giving you back the bonds. In that case, the liquidity is dropping, and this is incredible because they are not suggesting an interest rate cut, but even they suggesting they could actually reduce the balance sheet of Central Bank of Europe, which is a measure that you should only take when your economy is really strong and can support the sell-off of your balance. And that's not the case at the moment. Okay, so that was the most interesting point. In summary, Swiss National Bank was not making any change on the interest rates. Bank of England neither the case. And Christine Lagarde was, that's the mention point. Oh, retail sales from United States was published on Thursday. It was positive good. So positive too. So it means like even the retail sales in the United States, which is a kind of measure to see how strong is the situation in terms of consumption, internal consumption in the United States and middle class and so on. It's so good numbers. So still, they publish good numbers. Today, Friday, we got actually only few numbers. We got a PMI index, the production manufacturer index, no, prices on manufacturer index, and it was negative in all cases, below 50%, indicating contraction for the whole Europe, France, Germany, and European zone. All of them saw PMI index below 50, which means contraction. Not even that. It was worse than expected. Imagine if the expectation was 46, the result was 43, and so on. You can just check the numbers because we got the calendar over here. But in summary, it's showing us clearly that European Union is giving so many signals of recession already. So I would say that still the numbers, macroeconomic data from Europe is not good at all. You got here the results, 42, 44, 44.3 in the case of France. Germany 43.1, 48.1. The only exception was United Kingdom, which it was showing a composite PMI and services PMI with 51.7 and 52.7 respectively, which was even better than expected and below 50. So apart of that, rest of Europe is showing us clear signals of recession. Fixed investment on China drop again. Production surprisingly in China was good, 6.6%, over 5.6% expected. So that was the only positive numbers I will say we received this Friday. And also we got the PMI from United States and industrial production, which is dropping in the case of United States. Let me check the PMI, 48.2. So contraction also PMIs in the United States. Little stronger than the ones in Europe, but still contraction. Now, saying that, we have reviewed all the data for the week. We have reviewed also the comments from the Federal Reserve. We have reviewed also Central Bank of Europe comments and decisions. We also have reviewed all macroeconomic most important data published over the week. So again, if you're watching this freshly, the new week of today's 15, 16, 17, Monday 18 of December, you're welcome. Here is the completely update of the week, right? I hope you enjoy. Now, let's finish with a few views on commodity, currencies, and so on. So after these wars, we obviously have been watching how the dollar was getting weaker and weaker. Because if the Federal Reserve is admitting that they're going to actually consider the option of cutting interest rate, it means the dollar eventually in the future going to be cheaper than now, right? So the reaction of the dollar was dropping, as you can see here. Let's go even to 4 hours charts. But it's always better to see a long perspective. Was dropping the price since then, has been recovering little bit today, few points, but again, we got a kind of bullish figure here, which is a kind of reversal shoulder head shoulder, and it's completely gone because the movement caused by the Federal Reserve comments dropped the index, the dollar index below those levels that could keep the shape of the pattern. It's not the case, so the pattern is gone. And now obviously the dollar just getting a kind of pullback, but it's weaker. Dollar was weaker, but then therefore gold was rising. Take a look. Gold was rising really well, and it's again a natural reaction if you consider that the gold is the only alternative value, store of value for the dollar. It's not the euro, especially if you consider the euro is in recession. Euro is represent 20% of the total reserves in the world. 60% is represented by United States dollar. And the rest is just the rest of the currency. So we can see that actually the main storage of value is dollar, US dollar, and the gold is the only option you got if you are a central bank, if you are a national bank for any other country, if you are even investment fund, an offshore, whatever. you got two options. Either you keep your money in dollars, you keep your money in gold. But today, euro is not an option. Dollar has, based on what they say, Federal Reserve mentioned, they could drop the price. So, okay, gold is again the boss in the market. Gold is again a store value, and that's why we have seen the gold rising back again. Oil, it was rising also back. I will say one of the reasons could be because the dollar getting weaker forced those countries who sell oil to recover the price of oil for compensate the loss of value of the dollar. But still, the movement to me, in my eyes, it looks more like a kind of pullback to continue dropping. And as you can see, let me move to daily candles. But as you can see, the movement is so bearish. It's really a strong low tendency. OPEP on all those countries who produce oil didn't agree so clearly about what's the levels or reduction on production they want to apply. And as you can see here, we are close to very strong support for the last 2 years. So pay attention, because between $65, $68 per barrel is super interesting areas for those ones who are looking for get long in oil. Even that, stop this video here and take a look on ExxonMobil and Chevron with daily candles. You will see that actually they are in support for the last 2 years and amazing discount prices. So if you're looking for where to put certain liquidity and you like oil and gas industry, oil and gas sector, take a look on there, because the green revolution is making them super cheap right now. So they are actually really well discounted, and they are massive gigant companies in the industry with a massive discount too. So again, you pause the video, you go and check, and then come back, watch my eyes, and let's keep talking about markets. Last things to review, probably just the Bitcoin has been doing really well, an amazing job. And again, to me, this is the asset of the year. Look, whatever was happening in the market, Bitcoin was rising. Market was falling, Bitcoin was rising. Market was rising, Bitcoin was rising too. And now we got the Bitcoin in around $42,000 per Bitcoin. But even with a super nice, strong breakout over the levels of $38,000, $39,000. So amazing job, well done. This is Bitcoin. Congratulations, applause. And my friends, I think that's all. Please keep in mind, I'm updating every morning the comments about the market. You can see on my LinkedIn page, I'm just posting every single day what's the last news about the market. You got all here, all the comments I have done the last 48 hours. So if you want to keep updated, go to my LinkedIn and follow me. Otherwise, you can also go to my Twitter account. And actually, you know what? Actually, I'm gonna just leave here my contact details, so you can send me an email, because I got even a newsletter. I can include you in the newsletter, ATFX newsletter, for free, completely for free. You just send me an email if you like this content, and I'm gonna include you for receive every single morning on your email a fresh update, a list of the last news of the day, and comments, and interpretation about what's the global situation. Okay, that's all. Take care. Good luck this week with the market, and bye bye. And remember, you are not subscribed to this channel to keep updated about news. Bye bye.